Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, let's talk about something that sounds kind of dry, but is actually a huge deal. A single rule change in accounting is unleashing billions of dollars that were basically hidden on corporate balance sheets. We're going to dive into the wild new world of crypto accounting, a shift that's completely rewriting the financial story for some of the biggest names out there.
So, let's kick things off with a real head-scratcher, one that has confused investors for years. Picture this. A company buys $1 billion worth of Bitcoin. Then the price doubles. So on their official books, what's it worth now? Well, until very recently, the shocking answer was still $1 billion. Or, get this, maybe even less. How on earth is that even possible?
To really get what's happening now, we've got to go back in time a little bit. For the longest time, crypto accounting was, well, it was the Wild West. U.S. accounting rules had absolutely nothing specific to say about it. So companies had to shoehorn this revolutionary new digital asset into an old, dusty category that just completely distorted its real value.
And this really gets to the heart of the whole mess, right? You had this brand new asset class, something defined by its live market price, literally chained to ancient accounting rules from a totally different era. The actual economic reality, as one report so perfectly put it, it was completely obscured.
So under the old U.S. GAAP rules, which were the law of the land until 2025, companies were forced to treat their crypto holdings as something called an indefinite-lived intangible asset. Just think of it like a brand name or a trademark. This pushed them into using a model called cost-less-impairment, and believe me, it had some very, very strange side effects.
This is where it gets absolutely nuts. The old system was this bizarre one-way street for value. If the price of your Bitcoin dropped, even for a second, you had to write it down on your books and record a loss. It's like a permanent scar. But, and this is the crazy part, if the price then soared back up, tough luck, you could record nothing. That scar could never be healed. The value on your books was stuck at its lowest point, which meant a company's balance sheet could be showing its assets at a tiny fraction of what they were actually worth.
So you can imagine, this broken model drove everyone crazy. Investors were flying blind, and the companies themselves felt like their own financial reports were basically lying. So finally the cavalry arrived. The Financial Accounting Standards Board, you'll hear them called FASB, stepped in to fix this mess.
And the fix came in the form of this, Accounting Standards Update 2023-08. I know, it sounds super boring, but trust me, this was a landmark decision. It created the first ever official rulebook for crypto in the US. And even though it didn't officially kick in until 2025, a ton of companies were so desperate for the change, they jumped on board and adopted it early.
And just like that, with this new rule, the chains were off. Instead of that crazy one-way street heading down, companies now have to mark their crypto to its current market price, its fair value, every single quarter. This means all those wild swings in Bitcoin, the ups and the downs, now flow directly onto the income statement for everyone to see. It's a massive shift, basically trading hidden value for very transparent volatility.
But here's where the story gets another twist. You might be thinking, great, problem solved, right? Well, not so fast. Because while the US finally carved out one clear path, the rest of the world, yeah, they're on a completely different journey.
See, most countries outside the United States use a different set of rules called International Financial Reporting Standards, or IFRS. And when you look at crypto, IFRS is still totally hands-off. There's no specific rule for it. The International Board has basically decided to just watch from the sidelines for now.
So what does that hands-off approach actually look like? It means companies get to choose. Depending on what they do, they can treat crypto kind of like the old US rule, as an intangible asset. Or, if they're a broker, they can call it inventory. The big problem here? It creates a total lack of consistency. It's way harder for investors to compare two different companies, and you often end up with a value that has nothing to do with the current market price. So let's just put it side by side, because you really end up with two totally different philosophies. In the US now, it's a mandate. You must show the real market value, and you have to accept the volatility that comes with it. It's all about transparency. IFRS, on the other hand, offers a choice, which usually means companies stick to a cost-based model. This makes their earnings look a lot more stable, but it can completely hide the true value and risk of what they're actually holding.
Okay, I know what you might be thinking. Accounting standards, who cares? But stick with me, because this is where it stops being theory and the numbers get huge. This one rule change is having a massive, real-world impact, unlocking billions of dollars on paper and changing how we see a company's financial health.
I mean, this quote just nails it, doesn't it? Before this change, the financial books just didn't match what was happening in the real world. Investors were left trying to guess what a company was actually worth.
Want to see just how big of a deal this is? Let's talk real numbers. Take MicroStrategy, a huge corporate holder of Bitcoin. They estimated that just by adopting the new rule, their retained earnings, which is basically a company's lifetime of accumulated profits, would jump by about $3.1 billion in one go. That's not new money, that's just the accounting finally catching up to reality.
And check out what this does to a company's performance. When crypto miner Marathon Digital switched to the new rule, they booked a massive one-time gain. This literally swung their reported profit margin from being negative 29% deep in the red to a positive 57%, way in the black. Now, if you didn't know about this accounting change, you would get a completely warped picture of how their business was actually doing.
So the takeaway here is that balance sheets were transformed, literally overnight. For MicroStrategy, the value of their digital assets on paper pretty much doubled, instantly. And again, they didn't buy a single new Bitcoin. This was just the rules of the game finally reflecting the score. All right, so let's bring this all home. What does this actually mean for you? If you're an investor, a trader, or really just anyone curious about the crypto space, this stuff really matters. This isn't just for the accountants.
What this new transparency really means is that crypto's notorious volatility, all those huge price swings we hear about, it's no longer buried in some footnote on page 87 of a report. Nope, it is now front and center, an official line item in the quarterly earnings reports of major public companies for all of Wall Street to see.
So let's boil it all down. First, you get way more transparency, which is a massive win. But, and this is a big but, that clarity comes with a lot more volatility in reported earnings. The financials are now a much better reflection of reality, but it also means that you, as an investor, have to be really aware. You need to know if the report you're reading was written using US GAAP or IFRS, because they are telling two very different stories.
And all of this leaves us with one final big question, doesn't it? The era of hiding crypto's true value on the books is over. It's all out in the open now, for better or for worse. The real question is, are investors and are the markets truly prepared for the turbulent ride this newfound clarity is about to bring to corporate earnings?